morning, everybody. Welcome into another Everyday Growth Advisors pre-market live stream. Welcome in, guys. Happy Monday. Hope you guys had a good weekend. Back again with another week of mayhem here. Another big week. We have OPEX this week. We have another bunch of really big earnings coming out this week on growth tech. And I don't think there's a lot of economic news, but definitely still gotta have a close eye on markets this week because we could continue to melt up. But of course, we are also anticipating some kind of a pullback. So, what are we supposed to fathom from what has happened last week? And if you have had time to digest everything from last week, you should probably also think about how is that going to tie into the next couple of weeks heading into, the end of the year. And that's really important stuff because we'll know if, this is really going to cause a broader rally to the upside, or we're going to get, just a temporary rally, which is going to be faded away later on when CPI data comes out again in December, and then we have, stickier inflation than we expected. So, what is the expectation now? Obviously, I wrote a huge newsletter about this, and we already sent it out on Sunday afternoon. So I hope that you guys got a chance to read it and digest it. But we are of the view that obviously, in this kind of a sticky market, one CPI print is not enough for us to get, a positive territory right away. Now, obviously, there was a lot of unclenching of dealer gamma here, as well as the fact that shorts are still trapped at around 37,500, 3750 at SPX, and a lot of this was a combination of a short squeeze plus people scrambling for exposure to the upside, and yada yada yada. Then after that, you factor into the fact that people also FOMO'd into it. That's what caused mostly that two-day rally that was close to about 8% on the S&P 500. From the macro perspective, that has mainly been what has changed. Apart from that, you don't have all else much that has changed, right? But we have been seeing some interesting sector rotations that might be also telling us otherwise. So a few things that we have been watching that have been interesting is that the entire materials sector, XLB, has been rallying very, very strongly. Now, materials, if you guys don't know, materials sector is a cyclical sector that typically rallies, before the entire market rallies. It's one of the sectors that is a precursor to the entire stock market rallying, as is industrials. And so you can see both of these sectors actually have rallied pretty strongly in the past, 1 to 2 weeks, which is a nice little precursor. But tech has been largely trying to catch up here. And we see, that tech is probably going to remain a little muted in the next, couple of weeks slash let's just say 4 to 6 weeks. That's the time horizon that I'm giving this. I think that tech is still going to be muted within the next 4 to 6 weeks in terms of performance compared to the rest of the market. We did speak about semiconductors as largely as a secular trend that we saw coming out of its bust cycle, entering into a new boom cycle, which we have spoken about this at length on the live stream. For those of you that don't know, semiconductors is a cyclical sector, which means that at times, chips are in high demand, and at times chips are at low demand. And right now, with NVIDIA and AMD releasing new chips, that's when demand's going to start to come back, which is going to create a shortage of supply, and that is likely to drive semiconductor prices up, which will result in semiconductor pricings heading higher, their earnings improving, profit margins improving. And that's why the market is pricing in all of that right now. Obviously, also the fact that semiconductors have been oversold for a while, and so that's adding a little bit of a fuel to the fire, and all of those good things as well. Energy is also at a very, very key pivot point here, breaking almost into all-time highs, or likely, if we don't see it break all-time highs, then it comes back down to retest some key levels on the downside. So we'll be watching energy very closely this week as well, as I have already put it on the newsletter, right? I gave you guys a big clue about financials when it was trading at around $34, and right now it is at 35, almost $36. So this was a nice trade. I did mention, it would be a good intraday trade or maybe a 1 to 2 day trade. That was perfect. We hit it nail spot on. And so now, I think the main moves that you should be looking at here are looking for possible short opportunities in financials if there is a false breakout. Remember that stocks like JP Morgan and Goldman Sachs, they're very overextended. Now, does that mean you just go in and you take a crazy, all-in short position? No, it does not mean that, right? You have to take this structured approach to take the downside trade only when you see confirmation and you see rejections of key levels. Don't be too surprised if you see the market continue to rip to the upside. As I did mention, our key pivot point for bulls has been 39.50, and we closed above 39.50 on Friday, and we have opened and held above that level all the way through the Asian session, European session, and London session, and futures. Okay, so what's next on the books in terms of SPX here? So let's get into SPX and NASDAQ technicals first, and then we'll go back to the sector rotations and talk about those. Because I think that sector rotations are a little more difficult to figure out, but let's at least get this out of the way because this is a little simpler. Game plan is really easy. A hold above 39.50 sends us up to 41.50, right? Breakdown or pullback into 3900 or 38.50 with a bounce, we'll also see 41.50. That's your bullish scenarios. There are two scenarios there. Obviously, the first scenario is you come down, you bounce a little higher, and then you rally to the upside at 41.50, right? Second scenario is you don't even come down, you just continue running to the upside. Okay, so that's two bullish scenarios, personally. Bearish scenario is if we break down below 38.06 and we start hitting into these lower levels. The key bearish pivot is 36.40. Now, this is the less likely scenario. That's the reason why I'm not really focusing on it. So I think that a pullback here is the most important thing to see where demand starts to accumulate. And that's really going to be the key measure here. All right. Now on NASDAQ, you can see that the NASDAQ has underperformed the entire market, right? This is the reason why I said tech is going to still continue to be weak. Look at the NASDAQ. It's far away from its key pivot for bulls. And even the key pivot for bears is, it's significantly in the middle between both of these points. In fact, the NASDAQ has to make a lot more price action movement to the upside before we can consider this super bullish, because actually we are kind of in a muted, still downtrend here where we're testing the top of the trend line, right? So NASDAQ's really in a confused state here, or rather not a confused state, but it's in more of a difficult position, and therefore tech is going to be weaker in the next 4 to 6 weeks. This is the reason why I said that. It's not because of some hocus pocus or, if I have some crystal ball that is able to predict things. No, that's not what it is. This is basic sector rotation analysis, and you're looking at which sectors are really beneficial to trade in this environment, right? That's one of the things as a trader you have to know. You have to know the market well. What is strong, what is weak. You play on the things that are strong, or you short the things that are weak. More importantly, you have to be able to do that with high conviction and know which parts of the market you can do that with the highest efficiency. For example, you want to go short the NASDAQ. What's the best way to do it? Does anyone know? Put it down in the comments. Let me know. What do you think is the best way to short the NASDAQ? I would love to hear from you guys. Okay, so moving on. Now, IWM is Russell 2000 is the other equation which I want to talk about. Okay. This is a very important part of the market too, because small and mid caps have an unusual amount of interest here in terms of, the appetite for risk here. And I want to talk about that very quickly because, many of these stocks in this index, they have high betas, right? Obviously, you guys know that growth tech have high betas. And this is an important pocket of the market because people who are willing to take on risk right now, they are fundamentally avoiding mega caps like Microsoft and Google and Apple and, the likes of all of these bigger companies. Why? Because they have a more broader chance to fail in terms of earnings. But these smaller businesses, the ones that have competitive advantages, that might be high risk, high reward plays. These are being more sought after in a high risk environment right now. Hey guys, thank you for attending the live stream. Appreciate you guys tuning in. Once again, if is your first time here, make sure you hit the subscribe and the like button. Truly appreciate you guys, taking your time out to be here. And yeah, this is quite a few of you today, and truly appreciate it for taking your time out. And if you have questions, post them in the comments. If you want me to break down a specific ticker, put it in the comments as well. So Mark says NVIDIA, and then Dustin says SQQQ shares. Okay, so Dustin, you got it partially correctly, right? SQQQ is definitely a possible idea. To let's say you thought tech was weak, you go long SQQQ. Okay, that's fine. I think the main answer that I was looking for, and rather trying to make into a teachable moment, is levered ETFs, right? For example, TQQQ, right? You would want to take advantage of that kind of a pocket in the market when you know exactly what you're doing. It's kind of like, if you know where the bleed is, you can really put salt on the area and make it worse or make it better in the way that you want. And that's how you got to look at the market. It's not only just knowing where the opportunity is, but how do you squeeze the maximum juice out of that opportunity, right? That's really what you have to learn as a trader. Some people, obviously the basic parts of it is like, okay, we see SPX going up, let's trade Apple. Or we see NASDAQ going up, all right, let's trade semiconductors. Yeah, those are basic things that I obviously always keep mentioning over and over again, but it's also important, to know exactly what to get. Okay, so as I spoke about, IWM, important to look at. But once again, we got rejected off this top trend line. And let's see if we can continue with further downside management. Below 185 with the rejection would be a nice entry for a short position, possibly to retest some of these higher levels at 180 plus. So that might be a nice play if we can get that rotation out. Now, a couple of things that you need to know ahead of this week. This week is a OPEX week. What does that mean? Options expiry week, right? On Friday, there's going to be $1.7 trillion of notional options that will expire. This is courtesy of Goldman Sachs. Credit to Goldman Sachs. Thank you very much for this information. And we'll have about 720 billion of that will be SPX AM options. And then 310 billion of that will be single stock options, which will be PM settlements. So it breaks down into two sessions here, PM and AM settlements. What does this mean? There's going to be a pretty big jump in the dealer gamma positioning. Okay, and for those of you that have absolutely no idea what I'm talking about right now, you have to understand that when you trade with the market maker takes on your exposure, and all that exposure in terms of options has to be taken off or put on somewhere. Okay, and so all that exposure is going to be unwinded this week and rolled over to the next week or the week after that or in December. And they have already been doing this, by the way, in the past 1 to 2 weeks. Okay, we've been seeing them take increasing exposure on certain positions. So I will come back on Wednesday to give you guys more color on exactly what positions are being rolled on, because obviously I'm going to have to see what they are rolling into these next 2 days. And on Wednesday's live stream, I'll come back with a better picture on what's going on in terms of the dealer gamma. Okay, but just know that this week's OPEX is once again another $1.7 trillion that would be expiring. Okay. In terms of sector sentiment, so as we were getting back to that earlier, here are some opportunities that you should probably have on your radar. Tesla is a really great short possibility. It's in a nice bear flag. First target 177, and then below that 160 and 150. Okay, there's 3 targets here. I'm not giving the exact numbers because it's just round numbers. I rather say round numbers than the exact numbers. But we are seeing a lot of downside appetite in terms of share options positioning for the downside. Okay, so the market just opened right now, and so my alerts are all going off right now. So yes, Tesla, definitely a short opportunity. Also keep an eye on Amazon. This is also a possible short opportunity as consumer discretionary continues to be a troublesome sector. Financials, if we can get a rejection, look at those. JP Morgan, Goldman Sachs, both of them are really great. Okay. And that's all I'll leave you all with. That's 4. Obviously, there are a lot more, and I've posted them all on our Discord. We're watching a lot of these trades together on the Discord, and so I've given you a couple of them, and the rest of them, I'm pretty sure you can figure them out. Have a look at the market, manage your risk, have a great trading session, and we'll see you back on Wednesday. I'm going to jump on the Discord and trade live with the team right now. If you're interested in that, link is in the description. And I hope that, this stream was somewhat helpful for you in navigating what's going to happen this week, or, anything else. So thank you for attending, guys. I'll see you guys on Wednesday. Take care, peace, and love you all. Bye.